You found a stock that you like and you're looking to invest, but is it expensive? Is it cheap? Who knows? Just looking at the price and market cap doesn't give you much, so using something like a valuation multiple may give you more of a reference point to understand whether or not something is undervalued or overvalued. Today we're going to be digging into one of those multiples known as the price to sales ratio, talking about both the pros as well as the cons. The formula itself is quite simple. You can take the total market capitalization of a company divided by the total sales or trailing 12 months of revenue. You can also go ahead and take the market price per share divided by sales value per share. That gets you the same exact thing. Essentially, the number is showing you the relative value that you're getting per dollar of revenue that the company is generating. Usually, the lower the price to sales ratio, the better for the investor. Of course, it's more nuanced than saying if it's always lower, it's always better. So let's talk about the pros and cons. The first pro being that it smooths out the profitability of cyclical stocks. Cyclical stocks are companies that go through boom and bust periods of profitability. If you look at something like a commodity business, you can see that there are cyclicality or boom and bust cycles attached to how the economy is doing or how a specific industry is doing at that time. This means a company can go from making $3 billion in profits to $1 billion the next year due to market dynamics and not necessarily anything to do with the company. One industry that I like to look at as a good example is the steel industry. I used to work in this industry, so I have a pretty good understanding of how it works and the cyclicality of it. And based on the fluctuating prices of commodity pricing, steel companies can have really good years as well as really bad years based on that, or if the economy is doing well. If we look at something like Nucor, we can see a historical range of price to sales ratio over the years using something like macrotrends.net near 2009, end of 2011, 2020, where the economy didn't look that hot, things weren't going well, price to sales ratio was trading at a lower range. And as things heat up, the price to sale ratio expands. Around this above one number may be a time where the steel industry is hot, and this may be an indicator that around the corner we may fall down when it comes to steel pricing. Kind of an equilibrium comes to these markets where if these companies are making a ton of money and there's a huge margin, capacity will increase, and all of a sudden that margin will slowly go away and they won't be making as much money on the sales, and then their price to sales ratio may shrink. When I buy into cyclical stocks, I'm looking to buy closer to the bottom of that range because you can make a lot of money with cyclical stocks. We saw that in 2021. Coming out of 2020, positions like Nucor for myself have done really well. So when it is at the higher level, I tend to trim that position and maybe not focus such a big portion of my portfolio in that sector or stock. Another pro of this multiple is you can look at unprofitable growth companies and strip out the fact that they're turning a loss right now. Because if you use something like a PE ratio or any metric that focuses on profitability, you would never touch these fast-growing companies like CrowdStrike, Zscaler, Teladoc, you name it, because they're not necessarily making a ton of money and cash flow right now, but in the future, they have potential. So if you're a Warren Buffett disciple, you're probably not going to be touching these stocks, but you can miss out on decent returns as these companies have potential to scale, and then at some point they start becoming a money printing machine, something like Amazon. If you do use a price to sales ratio over a profitability metric, you may actually see that some of these companies are relatively undervalued compared to their peers or the industry themselves and the potential that they have. You can also use this multiple to compare like companies. Perfect example is Lowe's and Home Depot. Now, I don't own a home, so I don't have a preference for either of these stores. If you ask a dad that's constantly going to these stores every Sunday, they may have an opinion on which store is better. But if you look at the fundamentals of the company and what they do, Lowe's and Home Depot are very similar. If you look at the numbers, Home Depot is trading at a price to sales ratio close to 3, whereas Lowe's trades at a price to sales of 1.86. This reference point allows you to look at both companies and say, why is Lowe's trading at a lower multiple? Are they less profitable? Do they have a slower growth rate? What is this additional factor, and why are they trading at a discount? If you look at all these different factors and their growth rate, as well as the cash on their balance sheet, debt, all this kind of looks similar, then Lowe's looks discounted versus Home Depot. I'd rather own Lowe's over Home Depot because of the relative value. The last pro you have is the simplicity of the formula. It's just market cap divided by annual sales. You don't have some fancy Excel model that's calculating the intrinsic value based on future cash flows discounted by a certain rate using a tax rate rate, all these assumptions that go into a detailed DCF, you don't have to deal with when you look at a price to sales ratio. So far, this all sounds fantastic, but there are drawbacks to using something like the price to sales ratio. Take, for example, a company like CrowdStrike, which is in the cybersecurity space, and is currently trading at a price to sales ratio of 34. At first, you may say, that's ridiculous. Why would I ever touch a stock with a price to sales ratio that high? What the multiple does not factor in is the growth rate going forward. So the stock market is forward looking, and if this company is growing at, let's say, some ridiculous number, 300% per year, then that price to sales ratio is great. Whereas if this company is growing at 10% per year, I wouldn't touch it with a 10-foot pole. Another shortcoming is that debt and anything on the balance sheet is ignored. Just looking at revenue and price to sales ratio, if a company goes from 3 to 2, you may be saying, well, it's trading at a cheaper valuation the next year. But if they have a huge mountain of debt growing, they have to keep on paying more and more interest expense, all of a sudden that will lead to lower profits, and they have to deal with this whole debt situation, where if you just look at the price to sales ratio, the number may be going down, you think it's getting cheaper, but really you're buying into a company that is worse off financially. You could also potentially miss out on a great play or a company that's sitting on a giant pile of cash, and you can buy the business for relatively cheap, and your investment is backed up by these assets that are just sitting on the balance sheet. Another downside is if you look at a price to sales ratio of 1 for one company and 8 for another, that doesn't really tell you anything, especially if they're in different industries, because different industries will have different gross margins, profitability, as well as growth rates moving forward. It tends to be where technology companies are going to have higher multiples because there's more growth potential there and they have higher gross margins versus something like energy. Comparing ExxonMobil versus Facebook would be a perfect example. See, ExxonMobil trades at a price to sales ratio of close to 1, but looking at their operating margin, it's only 5.7%. Facebook or Meta Platforms, on the other hand, is trading at a price to sales ratio close to 8, which is much higher, but at the same time, their operating margin is 42%. And to boot, Facebook is growing at a much faster pace than something like ExxonMobil. If you watch any of my portfolio update videos, you know that I would rather own something like Facebook. At this point, hopefully you realize that looking at just the price to sales ratio on its own can be a con, because you don't really know if it's low, high, without approaching it with some context, whether that's looking at its peers, looking at the historical range, or looking at something like a historical average for that industry. I'll link this in the comments, but NYU releases this information on a yearly basis with the average revenue multiples, advertising 1.16, but if you look at something like drugs, biotechnology, that's 8. This is another way to look at industry averages. I personally use the price to sales ratio and have it in my bag of tools when evaluating companies, especially when it comes to cyclical and growth companies that aren't turning profits yet. If you watch any of my stock analysis videos, you probably see me mention this valuation method. Hope you guys had a good takeaway from this video and learned something. If you did enjoy the video, make sure to hit that like button, as well as consider subscribing to Webull. We talk investing, stocks, anything to do with money. Thanks guys for watching, and have a great day.